Loan discharge can be performed when a loan reaches the maturity date and is paid off by the borrower. Let us take a look at an example. In a previous tutorial on billing, we had run the billing cycle due on July 31st, 2015, so that the current billing cycle is August 31st, 2015. Let us process it. Note that we have 6 loans on the list. Let us cancel billing and rerun it. This time we will include matured loans. Notice that the billing date has changed to August 7, 2015. It means that we have one or more loans that have matured on or prior to August 31st. Let us cancel this billing again and change the billing date to August 31st. This time we include matured loans. Click Process and see that this time we have 7 loans on the list. Last time BAN 2365 was not included since it had matured prior to August 31st. When we ran July billing, Cindy had set the next billing date of every loan to August 31st, but for BAN 2365, it had been set to August 7 since the maturity date is August 7. When you run billing, including matured loans, Cindy automatically discharges the loans that have reached maturity. Notice that even though this loan is interest only, Cindy has recovered the entire principal balance of $1,345,000. Let us close the report and cancel billing since we'll perform loan discharge manually. If you want manual control over it, then do not include matured loans in billing. Instead, you should run loan discharge function, which we will study in this tutorial. Before we do that though, let us review a few things about this loan. Get to the loans screen and bring up BAN 2365. Go to Terms tab and notice that the last billing date was July 31st, 2015 and the next billing date is August 7, 2015 since the maturity date is August 7th. Click Inquiry and Print. As you can see, the principal was $1,345,000. Since it is an interest-only loan, we have not billed or received any principal. We have billed a total of $136,753.02 in interest, out of which we have received $98,644.70, since there are some unpaid billings from the previous months. Also notice that the borrower has paid $20,000 lump sum on the 2nd of July, which we put on account through borrower receipts. To cut it short, the borrower owes us interest billed minus interest paid minus on-account credit. That comes to $18,108.32. Of course, he also owes us the principal, $1,345,000, so that the total balance is $1,363,108.32. With this background, let us close the report and the inquiry screen. Go back to Details tab and click Discharge. Change the discharge date to August 7, 2015. Since this loan was last billed on July 31st, 2015, Cindy has calculated the interest from that date until August 7th. It is not necessary that a loan reaches maturity to be discharged. It is possible that the borrower wants to pay the loan off earlier, in which case you can discharge the loan earlier. You can enter any discharge date as long as it is not prior to the last billing date, and it will calculate the interest amount accordingly. In the present case, it comes to $2,192.53. The total payout is $1,365,300.85. The entire breakdown is given. If you click cancel at this point, the loan discharge will be canceled. Click payout statement to generate the final statement of account. It's a Microsoft Word document. You may put your letterhead on the top and customize the wording if necessary. Print and close the document. You may click Edit to change any numbers, reprint the payout statement, and when everything is satisfactory, you can post the discharge. The loan is marked paid out. The final step is to receive the money from the borrower. From the main menu, we go to Borrower Receipts and we bring our loan BAN 2365 and we change the date to August 7, 2015. That was the date on which the discharge was done, but this receipt date could be later than that. Okay, the receipt type is, for example, check. And you can see that we had calculated the total payout as $1,365,300.85, and it is sitting right there. So let's put it in the clipboard and paste it here. And this is the amount we have received from the borrower. Okay, let us see what it is made up of. If you go to principal and interest, then remember we had run all these billings up to July, and this was the interest that was calculated. Then from July 31st until the discharge date of August 7th, it ran a special billing. And that special billing, it recovered the entire principal, and it also calculated $2,192.53, which was the interest from July 31st until August the 7th. There are no miscellaneous charges. There is one unapplied cash which is sitting there of $20,000. We had said that we had received this money as lump sum on July the 2nd. So let's go back to receipt entry and let us say apply. Now, one thing is that, say for example, what happened was that the borrower went bankrupt, and therefore you have to write off this amount. You are not going to receive it. If you have to write it off, then you just check write off, cancelled, amount due. However, if you are going to receive the money from the borrower, then you do not write it off, in which case this money will go to the bank, but if it were written off, it would be debited to the bad debt expense. Let us add this receipt, and if you go back and you print unposted receipt, you will see that our receipt has been generated and all these old billing have been paid. This billing, which resulted from the loan discharge, is also paid. On account has been applied, and therefore the total amount that we have received is $1,365,300.85. We close it and post the receipt. And that is the end of the tutorial.